What a week.
What a
Pretty
week.
pretty big developments this week. We sold all risk assets on Monday at the close. We're no longer holding triple leveraged NASDAQ and double leveraged Bitcoin. And it so far it's working. So far it was a good sell, especially on Bitcoin. Bitcoin is really tanking now. It just took out Momo today, so I think I think things are going to get pretty ugly for Bitcoin in the coming days.
Yeah, so our sellout price on Bitcoin's about 115 or almost 116K. The key here is going to be, simply put, can we hold trend or not? We've been bullish trend. Bitcoin's been in a bullish trend for months, 6 months now. This is the first real attempt at testing the trend for real. Like we had these trend taps a couple times over the last like 2-3 months, but this is the first time price is like substantially below Momo, and this is gonna be a test here. If we can't hold a bullish trend, then expect lower prices. It's really that simple. Like this is not. At the end of the day, we're not short Bitcoin either. We took our leverage longs off at close to 116. So for us, we don't have a horse in this race, right? It's just if it goes lower, it goes lower. Um, if it does and then comes back into a bullish trend and we're in the right regime, we'll buy it again. Or if it holds here, it could bounce, reclaim Momo at 110, and that would also be somewhat of a bullish signal for the asset, but you're just not in the right regime right now. So it's for us, it's just not a long.
Yeah. And something to note too, historically, every major sell off in Bitcoin has occurred during a risk off regime. But that doesn't mean that every risk off regime causes Bitcoin to sell off. There's been risk off regimes where it chops around, but every time Bitcoin crashes hard, it happens during a risk off regime. And that's exactly where we're right now. We're in a risk off regime and Bitcoin is starting to sell off. So we'll see if this is going to be another big drop.
Yeah. My base case here is chop until we're bearish. So if you're wondering what I think of Bitcoin, I don't think Bitcoin, let me rephrase that. Bitcoin has downside risk. I'm not really bullish on Bitcoin due to the regime, but I wouldn't be surprised if it does or if it is able to hold Momo at 110 via pushing or, snapping back and forth and being able to hold it. Now, once we go bearish trend, my sentiment shifts more towards lower prices, right? Because the way that we do things here is bullish trends tend to lead to higher prices and bearish trends tend to lead to lower prices. So as long as we're in a bullish trend and trying to hold, it's not completely cooked yet. For us, it is, we're out, but in terms of like my expectations, it could still technically rebound.
Yeah.
Um, but
Yeah.
we're not long it. And then now we could talk about the NASDAQ too, because we did sell all of our NASDAQ out at like 25K as well.
Yeah, and that was a great sell. Like the market gave us a great opportunity to get out on Monday, thankfully.
Yeah. Now the question here, again, similar to Bitcoin, right? So our looking with Bitcoin is, or our view on Bitcoin is not being able to hold Momo is more bearish than how the NASDAQ looks. And we'll get to that in a second, but price is continuously breaking down in Bitcoin. So it's pretty bearish in terms of the momentum shift that's going on, but it's not yet an outright bearish trend. Now, if we take a look at NASDAQ, it's a little bit different, right? So Bitcoin's below Momo. NASDAQ is struggling to regain that mid-vamp level from when we had the Friday sell-off last week. So if we can regain this mid-vamp level, prices could go up. It's possible. Our confidence is that prices really run the way that they have the last couple of months is a lot lower given the regime shift. But it could happen if we reclaim mid-vamp and stay in a bullish trend, right? Again, in a bullish trend, the base cases are higher prices, and if we're in a bullish trend above mid vamp, there's still an underlying momentum pull there for higher prices. It just doesn't have the same confidence as if when we're in a risk on regime. So
Yeah.
understand that. Could prices go up? Sure. We're not by us selling out. We're not going short. Okay, we're just saying the confidence is not there at the moment to leverage to leverage the Nasdaq. It's just not. So we take risk off the table and we go flat and we wait for that opportunity to come around again. Now, from a structural perspective, if we can't hold mid vamp here, if the Qs can't hold mid vamp, expect chop and most likely lower vamp at 24,000. Now, this opens up the door to this entire liquidity cascade from last week. If we take out those lows, most likely Momo is in play then. So that's your setup right now. 24,800 on NQ it seems to be the resistance here. If that can hold and we can get back above it and it becomes support, prices could drift higher. If not, expect 24.2s. If Friday's lows break, expect even lower. And that's our structural setup there on the NASDAQ. Bitcoin, you guys already know. As long as this is below Momo, it's the trend. The odds of a trend shift are exponentially higher, and that's kind of where the base case is right now until obviously either we bounce or we flip trend.
I think for us to get a Momo touch on the NASDAQ, I think we're going to need some more deflationary or recessionary data points or news to come out for us to get down there. And I think we're starting to see that now. Like there's the talk today was all the regional banks and the risk that we could possibly have another SVB situation on our hands. I don't know. But yeah, the regional bank ETF is really not looking good. Looks like it's about to flip bearish trend pretty soon if it stays below Momo here. And that just opens the door. We don't know what's going to happen, but that's usually how risk off works. Like risk off triggers from our system, and we don't quite know what exactly is going to be the catalyst, but there is going to be a catalyst, and the odds of bad catalysts coming out during risk off regimes are elevated.
Right.
So I wonder if is this the catalyst? I don't know, but it has the potential to be.
Now we can talk about regionals because I know I'm pretty sure this one was a big loser today, right? 13%. You see the entire index down 6%, right? So regionals are getting hit quite a bit. And now we want to preface this by saying that we're never going to sit here and tell you guys like, oh, the world's ending. It's a problem. Like the odds aren't even in that arena to make those calls because they just don't end up working. 9 out of 10 times, the black swan event is not real. So we need to we need to look at this in a different perspective. What you need to say is, okay, look, the regionals are showing some stress right now, right? Even XLF as a whole, it was down 278 basis points today. So there's some stress in financials. Okay, that's typically not a good sign. It's not again, don't think a bank's going to implode overnight. Could it happen? Anything could happen, but that shouldn't be your base case. The idea here is that we went into a risk-off regime at the end of last week. Since then, it seems like certain stressors are picking up. Could we, in fact, be deviating more into that risk-off territory? Yes, absolutely. And that's the base case here. We're continuing into this risk-off regime. So there could be consequences in regionals. There could be consequences in financials. There could be consequences in AI. Think about AI expectations. Anything could happen. There could be negative consequences anywhere. The whole point of what we're saying and our objective is that the worst headlines tend to come out in risk-off regimes. That's when they matter the most because that's when those headlines create those liquidity cascades, create those large leaps of selling pressure, right? That's where you get them. In risk-on regimes, bad headlines get reversed very quickly. So you just have to understand the regime that you're in, bad headlines will not be taken well by the market. Now, to talk more specifically about regionals and the situation that's going on, if you look at the SOFR and IORB spread, you'll notice that to break the spread down simply, what you're measuring here is you're measuring the collateral rate, the rate for secured collateral, right, via SOFR. You have Treasury as collateral. And then the IORB rate, which is the rate at which banks can lend to the Fed, their reserves. So if the SOFR rate's above the IORB rate, it signals that there is stress in the market because you basically have the secured rate trading above the quote-unquote unsecured rate, which is the rate at which banks can lend to the Fed. So when this happens, it's a signal of stress. Now, a lot of people have been sharing this chart on the internet. and they've been claiming that this is a signal of a crisis coming. Now, we've seen spikes in the SOFR and the SOFR spreads happen a couple of times over the last year. To sit here and say this is going to be what puts, this is the straw in the camel's back is nonsense. I do think that there is some validity here to say that like the way these SOFR spreads are trading is concerning, but this is not the final be all because there are certain maneuvers that could be done. Simply put, later this month, if the Fed were to taper off QT, that would help this. If the Fed were to reduce rates with dovish guidance, that could help this too. There's a lot of things that can ease the pressure in this field. Now, a lot of people are looking at this and saying that this type of crunch on liquidity is what's going to create another banking cascade like SVB. And I just don't think that that's, first off, break this down into two things. We cannot just be betting on banking cascades. That's not a profitable macro strategy. And number two, you saw exactly what the market did last time and what the Fed did in response when SVB happened. So in a weird way, there is a market backstop. There's a Fed backstop for regional crises. If it's BTFP 2.0, whatever it may be, whatever the solution is, if it's down to banking, the Fed will backstop it. Now, that's why I'm not too concerned about regionals as to like them being a systemic shock and macro crusher, right? Like 2008 style crisis. It's just not a concern. Could there be stress in the regionals that bleeds over to more and more regionals, and could it put regional stocks down quite a bit and create fear and lower expectations in the economy? Yeah, that's possible. Could it tighten credit conditions? Yeah, that's possible. But again, we're not here like expecting tomorrow after the close for massive amounts of banks to go out of belly up. That's just not the angle that we take.
Yeah. Another possible catalyst too would be the construction industry. That's been pretty weak lately. I wonder if that's a risk as well to the market. Like if you look at like Home Depot, that thing looks like dog shit.
Yeah. Well, I think you and I had a conversation about this earlier this week. When you look at names like Home Depot that are just down quite a bit, right, from the last FOMC meeting, basically the big pivot, right? The rate cut finally happened and Home Depot sold off. And then you look at something like Caterpillar, right? And Caterpillar is just extraordinary, right? Compared to Home Depot. Like this is kind of in a simple way, you can almost see the bifurcation in the markets between construction and AI, like normie construction and AI construction, right? Because if you're building an AI data center, or data center in general, right? Large scale construction projects, you're not going to Home Depot. The average Joe is going to Home Depot, right? So Caterpillar can look great if they have these big if the capex tailwinds for data centers are huge, Caterpillar will benefit, right? Because they're in the real industrial construction business. But when companies like Home Depot don't do nearly as well, and I mean we could take a look at Lowe's, right? They're just the same. They don't do nearly as well. You have to ask yourself, okay, well, it's very evident that AI has been a tailwind for growth for a while now. If it's through productivity enhancements, if it's through outright positive output from data center creation, right, and capex spend, however it comes to be, there's a tailwind from AI in many different ways. Now, I wouldn't say AI is holding up the entire economy. I think what it has done, especially in the output side, if we look at output in terms of growth, AI has enabled a huge surge in productivity, which even with job contributions falling, you're seeing output remain very nicely positive, which is signaling that productivity is doing a lot of the heavy lifting. And we outlaid this dynamic in the last ledger note we wrote last weekend, that this is in some way also a risk to the economy. Because if payroll growth continues to slow, it's not bad yet, right? Like it's not necessarily creating an environment that's negative, recessionary. Output is still positive. But if payrolls slow to the point where they really expose productivity, any shock in productivity will lead to a shock in growth. And it almost seems like that's what's been going on here. Again, job contributions are overstated in the output numbers because payrolls have been revised down significantly. So the number that you're looking at, if you look at real output for the second quarter of 2025 at 2.48%, and jobs were 0.97%, job contributions to that real output were basically 1%. That's overstated. So that's even lower than 1%. And that means productivity is understated and productivity is even greater than 1.5%. So more than half of the real output, at say 75% of the real output at least, has been through productivity contributions, productivity enhancements. And you can argue AI is a driver there. But that also opens up a possibility, and this is how we navigate our risk regimes, right? Through our risk cycles is when we're in a risk-on environment, our fundamental thesis has to be bullish. We have to be looking for bullish sentiment, bullish signals, bullish readings, whatever it is, bullish narratives. Because you're in a risk-on regime, you have to find the bullish narratives, anchor into them, and use them as a guide. The system is the signal, the narratives are the guide, right? We're not building narratives and sticking to them no matter what the market is telling us. We anchor our narratives based on the readings of our system. So once we go to risk off, we have to take a whole new approach to this. We have to wipe the slate clean and say, okay, system's saying risk off. So there's something brewing here. It might not be major, but there's something brewing. So where are all the areas that we're excelling in, that we're basically propelling the risk on environment? And what are the weaknesses in those areas? Productivity was fueling the risk on environment for months, quarters, right? And the exposure of productivity, or the size of productivity's contributions, are also, as they were a tailwind, can become a weakness. And this is, I think, one of those things that we have to watch out for, because if the whole economy hinges on productivity contributions and they stall out for whatever reason may be, maybe it's a shift in capex, if it's a shift in AI sentiment, whatever it is, or capabilities, scalabilities, anything, could be anything, productivity will fall. But you won't have, like you did in 2022, where productivity was actually negative, but job contributions were so strong that it was offsetting the negative productivity. You have the complete opposite now. Everything hinges on productivity. So if productivity falls, it's going to be very hard for growth, output, GDP to remain in the trend that it's in.
Unless hours worked also is able to fill that gap. And it looks
Yeah,
like
it's possible.
the hours have been ticking up since Q1 2024. So I
It's
wonder if
possible, but
it might balance itself out, but eventually it's going to get to a point where it's not sustainable.
right. And being in a risk-off environment, we have to not make this our base case, but be aware. Like I said earlier, the key is be aware of your surroundings. We're in a risk-off environment, so we have to be aware of where the vulnerabilities are. This is one of them, right? So GDP has been running quite well. I mean, we haven't gotten the GDP nowcast update given the government is shut down. Ideally, that ends somewhat sooner than later when we can start getting economic data again. But you get the point here. Our case and base case has been, when we're in a risk-off regime, we have to look at it a different way. Yes, GDP has been strong, right? So real GDP has been printing 3%. We've been printing 3%, and we are estimated to print 3% this quarter, or quarter three, sorry. And then where we go into quarter four here, once the government comes online, GDP now will be recalibrated, but ultimately, we're looking at 2 back-to-back quarters of 3% plus GDP prints. So being in our risk-off regime, what do we have to tell ourselves? Well, we had 2 back-to-back 3% quarters of GDP growth. We know that productivity is propping everything up. Any sort of slowdown from the expectations, like what if GDP comes in at 1.5, 2%? It's not necessarily recessionary, but it'll be a big slowdown from what the market was what we've been experiencing the last couple of months, the last 2 quarters. And these are the perspectives you need to take, because we're not calling for a recession. We never do. But we are saying that in a risk-off environment, risks are higher that things don't materialize in a good way.
Yeah. And it is kind of hard finding these bearish narratives at the start of a regime flip because once they're obvious,
It
the
goes both
market's already
ways though.
pricing that in. The
Yeah, it
move
goes
has
both ways.
happened.
When you're in a deep risk off regime and everyone's, crap in their pants, it's hard to find a bullish catalyst too.
Exactly.
It's at the regime. So we find that the greatest amount of confusion in our not in our okay, the greatest amount of confusion in sentiment around our models comes upon regime pivots. It's when you've trained yourself for many months or many quarters to believe a certain flow of things, and the system shifts, and you're not quite there yet on a narrative basis. And that's the dislocation that happens at pretty much every regime pivot. Members that have been with us for a while now, they know exactly what I'm talking about. They've seen it, they felt it. It's just how this progresses because, again, the system is spitting out signals and your narratives are hinged on feelings. And one of those, if they don't align, one of those will win. And more times than not, the data will override the feelings. So, what we find being helpful is just to stick to the process and don't overthink it, right? Like, we're not here to climb the top. We're not here to try and make money on the downfall of markets. It's not the objective. The objective is just to avoid uncertainties in risk assets if you're not in a regime that yields high confidence, especially when you're using leverage. Remember, we long Bitcoin with 2 times leverage. We long NASDAQ with 3 times leverage. So if the stars don't align and the confidence isn't there, you bet your bottom dollar we're going to take the leverage off the table because that's just where mistakes happen.
Yeah. Yeah, our way of playing it is we get full conviction to the point where we're able to lever up 3x or 2x without worrying too much that we're going to get a drawdown that takes us out of the game. And so far, Aries has been backtested to 1991. There's never been a scenario where a massive market crash happens that we are long with triple leverage in it the whole
All the way
time.
down. Yeah.
That just doesn't
Yeah.
happen. And if
Yep.
you're able to avoid those things, you may as well lever up, may as well capitalize on these high conviction plays. And right now, risk on is just not high conviction.
No, it's not. Another thing I've been watching, I mean, everyone's been watching is gold, right? Just absolutely just ridiculous. Like this is just disgustingly ridiculous. Like
Yeah,
just
that's wild.
we've gone from bull market to like 90-degree angle. Like this is just up. Literally, if you had to name a chart of up only, it's been gold this year.
And
And
I feel like this is getting now to a point where it's not even a risk off asset anymore. Like if a
yeah,
recession
it can't be.
hits, I don't think gold is what is gold going to go to like 5,000 when a recession hits? I don't think so.
I think the key here with gold has pretty much been like, if I had to guess, this has been what's fueling gold is the fact that we just can't hold any positive spreads on inflation swaps. And obviously, not the directionality of this. This is more of just a theme. If you look at inflation expectations over a long enough time frame, right? Like, let's go back 5 years, right? Take a look at swaps here. You'll see that we have not taken out like the 2.5% barrier on inflation swaps. And we go back let's just even go back way further, like 10 years. Like you see what I mean? Like in 2018, the high was 235. We're just not, we're at 25, 248, 25 right now. And we can't really get to the levels that are somewhat, acceptable with the Fed's target for longer term inflation expectations. Now, I think what that did, and this is my theory on gold, and I kind of laid this out on X, but I'll say it more clearly here. This all started behind two things, in my opinion. Number one being the Fed, the expectations of the Fed cutting rates for the first time. right? Back in for the end of middle of 24, right? When quarter 3 24 when we started cutting rates. On top of that, we had some political issues with Russia and bank sanctions that definitely helped assist higher gold prices. And there came this expectation when the first rate cuts started coming, the way they were coming, right? That the Fed was in fact moving too quickly ahead of proven lower inflation expectations. So I think early on you had the regular macro trade take place where gold was doing its thing, going from 2,400 to 2,900, something like that on dovish Fed, security concerns globally for reserves, and higher than target inflation expectations, fairly put. And I think what happened here is when we went into Liberation Day, things became even more hyper in terms of the rest of the world being concerned about holding U.S. collateral, like U.S. Treasury collateral, especially countries like China, that they still obviously have to hold U.S. dollars, but they're going to try and diversify their reserves away, right? Because they do not want a large exposure to America as much as, maybe they did have at one point. And that might not mean by outright selling treasuries. That just means beefing up reserves in other categories. So at some point here, you had China jump on the bandwagon as a tailwind. And I think at some point over the last 12 months, I'd say 12 or so months, you unhinged a whole new door of speculators, and they've kind of overwhelmed the gold market. So the macro trade in gold, to simply put it this way, right? Gold is up 60% for the year. People are saying that's because fiat's worthless, right? But the price of milk is not up 60% in a year, right? For example, the price of goods, the real world did not debase 60% in a year. And this is where I'm starting to think, or my thesis has been that gold is somewhat detached from the macro trade and has become a speculator's trade. Nothing wrong with it. Money to be made, on a phenomenal run. But if we have to fundamentally lay the basis for this idea, if the theory is right that gold is now a macro trade, gold is no longer a pure macro trade and has become a speculative trade. Okay, if that is true, then we can branch out to two scenarios. If speculators have a control of gold, speculation is no longer on the side of gold being a store of value deflationary hedge. You've now tilted gold to risk-on properties. So if there is a negative risk environment or negative shock to risk assets, right? Are the people long gold the same people that, this is the question, are the people long gold the same people that are, say, very conservative, or do they have leveraged equity longs as well? Are they thinking, okay, I'm up a lot on my gold, I can use gold as collateral for my leveraged longs because gold's a risk-off asset, right? Theoretically, in theory. So is gold now more convoluted to the point where it is in a position that is susceptible to margin calls, right? Because if the same players that are leveraged long risk are also leveraged long gold, the risk of margin call or liquidation correlation is converging to the risk asset side, not the safe haven side. And again, I'll say this simply. What's gone wrong in the world for gold to be up 70% for the year? What central bank is imploding? What nation is experiencing hyperinflation? These are good questions if you're long gold. Just ask yourself. Not saying you should sell gold. Manage your own position. Is gold very extended? Yes, it's insanely extended. But on the contrary, it feels like this is what a melt up feels like. Exactly what not stocks aren't melting up, Bitcoin's not melting up, it's gold that's been melting up, right? This is where the melt up is. And you don't want to short melt ups. That's how you get smoked. So that's not the objective here. The objective is just to ask yourself, in a risk off environment, does gold provide the same properties as it does in a normal risk off environment? If we are in a risk off environment now, will gold provide the same beneficial qualities as in typical risk-off play. And my leaning is actually it's probably not. And the reason for that is just given what gold's done. Again, remember, gold's detached from real yields, gold's detached from treasuries. Gold's been on its own run phenomenally, record run. Awesome. But great, right? But ask yourself, okay, if there's a real problem, does gold have liquidation risk now too? How many people are long or are pushing longs in gold? I mean, we're talking 30, what's gold now? $30 trillion?
Well,
Right? Massive.
to add to your point too, that the speculators have gotten involved is just look at other minerals as well. Like
Yeah, it's not
it's
just gold. It's
yeah,
not just gold.
it's
No.
become like a thematic play of buying metals.
Palladium, right? Like palladium, and then we can look at, let's see if we can look at platinum. Here's same. It's all the same thing. I mean, even silver, right? Like I think again, metals have been hot even through rare earth minerals, right? You could see through typical ETFs for rare earth minerals, they've been. Notice this all starts like June. Rare earth minerals were dead until about July. They start ripping, right? And you notice gold, same thing. GLD was about end of August. Then it really took off. Like gold did a lot. If we take a measure of gold's move, right? So gold is up 28% since Jackson Hole, essentially, right? So a good portion of the year's gains in gold actually happened in the last 2 months. And it seems that it's been very correlated with just a general rise in like rare earth minerals, like, you know, these rare earth companies that are getting bought out or stakes being taken. These seem to be fueling this thematic tailwind behind precious metals. You know, if you look at copper, it doesn't look the same. Copper does not look the same, right? And my case here is if you get these thematic tailwinds that are very, very almost bubbly, does gold really hedge? Like, we'll go back to gold. We'll say, look, gold's up. Does it really hedge? Now, gold's been a great long, but I don't think it's been a great long for risk off. I think it's been its own long. Gold has not been a macro long. Gold has been a thematic long,
I think
right?
it started off as a macro long.
Yeah, it started off as a macro long. It became a thematic long. Now it's a speculative long. It went through the. Now some might be saying, well, are macro and thematic the same thing? Not necessarily, right? Because in a typical macro environment, gold is the stagflationary player. Gold is when rates are not favorable and bonds have downside risk. Inflation is a persistent issue, but growth is not strong enough to support the rise of other asset prices, and you want to hold something that will give you a positive yield, a return on your store value, buy gold. That just hasn't been the case. Real yields have been positive. Risk assets have been rising. Inflation it's not as crazy as, like, again, gold is a scarce asset for sure, but it's not this scarce. It's just not. It's not this scarce that I guess it needs to be marked up 60% in a year, which is why I think, and we saw this back in, let's take a look at gold back in the day. We saw gold do crazy things back in the day, and it's possible that you're facing a situation where gold goes on a run, kind of like this, and then it goes sideways for some time. It restabilizes. Now, similar to the 70s and 80s run, if you own gold at, like, in comparable terms, anyone that bought gold at 110, right? After the 80s run, they didn't really have to worry about their low cost basis at all, pretty much. Now, I think the case can be made here as well. Like, if you're long gold from, the 23s to 2023, 2020, early 2024 region of like 2000, your cost base, you're deep in the money. Your cost basis is somewhat secured, right? Gold's not going to zero. It's definitely not gonna. I don't think it's gonna retrace this whole move. But the longer this goes on, and the point of me even bringing all this up is the higher the risk rises that gold becomes a stagnant asset and it doesn't hedge risk off environments the way it should, because speculators have to get rinsed out of the chain or rinsed out of the order book. So I think that's the risk for gold at the moment. Now, that's again, don't want to say it can't go higher. If some of you are long gold, don't take this as a sell gold trigger. Manage your own risk. I mean, another thing, Artie, we've seen gold has not gone under mid vamp since since pretty much pre Jackson Hole.
Yeah, it's
We have
wild.
not been even like this is a good example of like not of like one time framing price action. This is straight up. This is one move, a single move up. This is there's been no dips to consolidate. So the longer this goes on, the more the risk rises of some sort of vol event in gold. Might not be crazy, but people become complacent very quickly in moves like this. So just if you're strategically trying to play gold, gold shouldn't fall below 4150. Really, it shouldn't. It shouldn't be able to hold a move below that. If it does, you open up the doors for a more serious dip. If you're a long gold from prices from well below, then just if I were long gold from those levels, I use that as a stop. That would be my stop, and kind of just let this melt up, continue to melt until it burns out.
Yeah, I really don't know how much longer gold has, but I feel like it's coming to the end soon. I think the way it's going to end is we're going to get an astronomical overnight gap up, like something stupid where everyone looks at it like, oh, there's no way. Um, like 3-4% move overnight. And then during the day, probably also goes another 2-3%. And that's when it's going to top. I think that's how it's going to end. And I don't know when that's going to happen. Is that going to happen soon? Is that going to happen once we hit 5,000? I don't know, but I think that's how it's going to end, is once it literally goes vertical.
Yeah, I mean, it's definitely so. Gold's been very interesting along, and I think like it's been a very interesting thing to watch because um, I'm starting to see people that are saying things like gold's not overvalued, it's underowned, and things like gold's gonna hit 10K an ounce. And the crypto bros, you know how this goes. It's the gold's up 70% for the year. Gold, the yellow rock, it's up 70% for the year almost. Like we should have some sort of expectation that like, yeah, this is an impressive move. We should acknowledge that. We shouldn't be outright calling from for a straight 2x from here. Like that doesn't make any sense. Could it happen? Yeah, like I said, as long as you're in melt up mode, as long as you're over this level, so you can keep going. I think that there's the asymmetrical risk in gold is rapidly rising to the point where you run the risk of having some sort of liquidity event or liquidity crunch where shorts are going to get shorts have been getting blown out, and then leverage longs that are stepping in and trying to throw money at on the up only move are going to get wiped. And I think you kind of need to see that happen before gold becomes a typical risk off slash safe haven asset again. It's at this moment I think is more correlated to risk assets. Now, this actually opens up another point for discussion here, which is commodities as a whole, right? Because if you look at crude, I've been talking about this quite a bit, and some people are a little confused as to like what the $60 per barrel level is. And if we take a look at what happened here, we'll take a look at what happened here on Liberation Day. We had to slam down to 60, the recovery. And what happened here with crude is we've seen this very noticeable effect with equities when crude has been trending down below 65 to $60 a barrel. And my thinking is crude has this double-edged aspect, like all commodities do, where they're an inflation gauge, but they're also a growth gauge. If crude is recklessly falling, or rapidly falling, or persistently falling, it means two things. There's a supply glut. Okay, meaning there's a surge in supply. Okay, that means lower inflation expectations. But it also means if the supply glut is too massive, is there not enough demand for energy uptake? Is there a demand concern? Right? So it's this double-edged sword. Lower crude is good for inflation expectations. It brings them down, but in some way it also weighs on growth expectations, on the possibility of having lower growth. Now, there are regimes like expansion where you have these falling inflation expectations but positive growth, basically negative inflation impulses but positive growth impulses. And those environments are very interesting because what happens is the inflation impulses are falling and they're creating an environment of lower inflation expectations, cheaper goods, and that's almost refueling growth. So it's lower inflation expectations are fueling growth. In a deflationary regime, it's lower growth expectations that will continue to fuel lower inflation expectations due to demand constraints. So there's these two dynamics that can happen, and watching crude, I think, shows some value. But the way crude's been falling, we're already past Friday's low. My focus is now actually shifting to copper because we're getting this downward move in crude now to the point where, like, I wouldn't be surprised if crude continues to break lower or chop around and continue lower. It's copper now that's been holding up much better than crude. I mean, look at crude. Crude's below the Friday lows. Copper, not so much. And look at commodities overall. Commodities are still in a bullish trend. So if you're looking for disinflationary tailwinds, the lower crude prices are a good sign. They might be a warning sign for growth as well. But overall, commodities are not actually breaking down just yet. I think we're going to need to see GSG really take out Momo, and it seems like we can't get back over mid-vamp. So lower vamp Momo seems to be like the next area that commodities want to test. And if they can't hold this, commodities break lower, expect swaps to go even lower. So swaps are going to dive lower. Inflation expectations are going to dive lower. And expect term premium to come out of the bond market, and expect growth fears to only accelerate. So thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.
We're also going to do a Q&A with the members in the Discord right now. So if you guys are watching live on X, you can go to our website, join the Discord, and you can join in on the Q&A.